Since mid-March, U.S. 10-year yields have traded in a pretty tight range defined by 3.6% on the upside and 3.3% on the downside. The indecision in yields appears to be reflecting the move away from the Fed's tightening cycle and now is focused on the transition period before the easing cycle begins. The Fed funds futures market, according to the CME FedWatch tool, is now predicting 50 to 75 basis points of easing by the end of 2023 and 200 basis points of easing by the end of 2024. Latest data point affecting markets is the Federal Reserve Senior Loan Officer Survey, which concluded that the percentage of banks who are currently widening the spread between their cost of funds and the rates that they're charging clients is the highest since the financial crisis of 2008. And that loan demand was falling fast as well. Now, of course, the implication here is that the phenomenon acts as an additional rate hike and could influence Fed policy quickly. Now, on May 10th, we see the next read of the CPI. Expectations are for 5.0% year-over-year rise, but we saw a sharp incline in crude prices in April compared to that in March, and that could affect the number. Now, if a trader believes that 10-year yields will fall from here, they could express that by selling the May micro 10-year yield contract at 3.50 and target a return to the psychological level of 3.00. A stop for this trade could be placed above at 3.80. Now, this trade could make $500 if your target is reached and risks $300 if you're stopped out of your level. If a trader believes that yields will rise from here, they can express that by buying that May micro 10-year contract at 3.50 and targeting a move to the November highs of 4.24. A stop for this trade could be placed below at 3.15. Now, this trade could make $740 if the target is reached and risks $350 if you're stopped out of your level.